Do you have an age gap between you and your spouse or common law partner? Or maybe there's a life expectancy difference or a retirement age difference. All of these factors come into play when planning for retirement. In this video, I want to cover this off, how to plan around this, and how to make sure your retirement plan is bulletproof for your future. So when it comes to having an age gap, a lot of times one person's retiring while the other person's still living. And again, this may happen even if there's no age gap. And what we see all the time, in a big fatal flaw with regard to tax planning, is the spouse or person that retires earlier typically doesn't draw an income. So let's say that we have, in this case, we have John and Andrea YouTube, and I'll show you this in a minute, in that John's 65, Andrea's 57. John retires, Andrea continues to work. But they can live off Andrea's income, so John just doesn't take any income. He doesn't start drawing down his RSP. He doesn't worry about any of that. But because he was 65, he wanted some government money, so he started his Canadian pension plan and old age security. But outside of that, he doesn't have any income, so his taxable income is very low. Thus, his average tax rate is close to zero after his personal exemptions. This is a fatal flaw that many of you make. You want to make sure you're leveling out your tax rate. So in this scenario, when we look at John, you can see his marginal tax rate is 20%, and that stays pretty level right through retirement, which most people will look at and say, well, my marginal tax rate doesn't jump anywhere, so this is a great tax plan. But when we look at his effective tax rate or average tax rate, you can see that it's essentially 0% until Andrea decides to retire, and then it jumps up to 3% and 7%. So again, you have this kind of laddered tax income. Now, if you're someone that's planning for retirement and you want to pay CRA less money, a plan like this isn't the best plan. And so what John would typically want to do here is start drawing down a bit of his RSP. So just because they can live off Andrea's income doesn't mean that they should. They can start drawing down John's RSP, top up TFSAs with that money, do other things with it. But you want to make sure you don't have a 0% average tax rate in retirement, unless that's your average tax rate right through retirement, which is wonderful. But for most of you, you're going to have a bit of this roller coaster. The smoother you can make the roller coaster, the less tax you'll pay, the more money that goes back into your pocket. Now, to piggyback off that thought, a lot of you in retirement are not building up your TFSA. You've built it up to retirement, but now you're starting to draw down your RSP, maybe even drawing down your TFSA a little bit. But utilizing a strategy like this, where we're drawing more money out than you actually need. And this is a concept that a lot of you need to employ in your retirement plan, but haven't. And so you might be taking out more taxable income, and thus, yes, you're paying more tax now, but you're topping up that TFSA with that extra income. Now again, run these numbers with your financial planners. Our team does this day in, day out for hundreds of Canadians. And let me tell you, the majority of the time, if you have a little bit too much, or again, you have a bit of an age discrepancy like this, or a retirement age discrepancy at least, it typically will make sense to draw more money out than you need, trigger a bit more tax, level out that average tax rate through retirement. Because again, there's two parts of retirement planning. There's the cash flow tax plan, and then there's the actual need. So in this case, we're drawing out more of the RSP, taking that money after tax, topping up the TFSA, giving ourselves more flexibility down the road, but also leveling out that average tax rate. So it's a win-win. Run these scenarios with your financial planner. Don't just think, we can live off Andrea's income. I'll just kind of sit back, not touch anything. I'm paying no tax. That's great. Well, it sounds great on the surface, but again and again and again, you'll see that it actually means you're paying more tax. And it's hard to kind of comprehend that. I get that. Zero tax means more tax. But Adam, I'm paying zero tax. You're just bumping it down the road to a higher tax rate. And for a lot of you, you're bumping yourself into a higher marginal tax rate, pay a higher percentage of taxes. So again, level out that tax rate. Another planning concern for a lot of people that are retiring that have different age groups. And again, we've done plans for people with, 2, 3, 4 year age gap, which I have with my wife, 4 years. We have people with 30-year age gaps. It's everywhere. So it doesn't matter what your age gap is, but if there's an age gap big enough that, by the time I'm done my go-go phase, my spouse or partner is just coming into go-go phase. Like, there's a discrepancy here. And so as you sit down and plan with retirement, with your planner, with your spouse or partner, you want to discuss, what does go-go look like for us? It's going to be not your typical go-go phase. If you're 65 and your spouse is 45, that 20-year age gap is going to throw off the go-go phase. So does that mean maybe from 65, when you're 65 to 75 and they're 45 to 55, maybe you're doing a bit more traveling. Even though they're working, maybe you're doing a bit more traveling there. So again, you have to kind of massage this go-go, slow-go, no-go phase because you're basically in different time zones. And you need to figure out how do we make this come together so that when I retire, I can still enjoy my go-go phase of retirement. And I'm not kind of waiting on you because if I wait on you, I'm in my slow-go or no-go phase already. So again, there needs to be this massaging. So a plan in retirement for someone with a big age gap with regards to the stage planning, go-go, slow-go, no-go phase, making sure you actually enjoy your retirement, you're going to have to make sure that you actually have a different type of plan where the older person is able to enjoy the go-go phase and not on their own, which means it's a bit of a sacrifice for that younger person. Look, you're going to have your go-go phase later, but you need to kind of enjoy some of that go-go phase with your spouse or partner now. Another big concern or communication with your partner needs to be around CPP timing. If there's a 7-year gap, a 10-year, 20-year gap, timing on CPP matters. And here's my opinion on it, and then I'm going to break it down into the software to show you a few scenarios. Now, again, we talked about, not taking your CPP and passing away before you take it. And we did this video just last week. Check that out. We'll link that below. But that talks about if I wait till 70 to take my CPP and I pass away before I take it, is my spouse better off or worse off? And again, there's some scenarios there. We broke it down in that video, so check that out. But the other thing is, if there's a, let's say, 7-year age gap, which I have here in John and Andrea's sample plan, you'll see that, how do we kind of massage this with regards to timing? Does one take it earlier, one take it later? Do they both take it later? And at the end of the day, you need to sit down and run these. It blows my mind how many people I talk to day in and day out that say, yeah, I got a plan from my bank and they have me taking CPP at 60, 65, whatever it is. I said, well, what did it look like at 70? I don't know. They didn't run it for me. Have your financial planner run different numbers for you. If they're not running the numbers, they're not doing their job. They're taking your information, plugging it into software and giving it to you. That's not a financial plan. That's not a retirement plan. They need to be working the numbers to figure out where is your sweet spot. So if we jump into the plan here with John and Andrea, again, there's an 8-year age gap between John and Andrea. John's retiring, Andrea's going to still work, so you can see her employment income for a few more years. She plans to retire at 62 when John is 70. You can see here, John took his CPP at age 65. So he's retired and he started a CPP and old age security right away. Again, his effective or average tax rate is close to 0. And Andrea is going to take hers. In this case scenario, we have her taking it at age 70. So delaying it a little bit. And I'll talk about that here in a second and why I would recommend that. So if we look at their combined CPP, you can see, we have John's coming in and then it bumps really high at age 70 once Andrea starts her up to 43,000 combined. And then Andrea will have a CPP survivor pension once John passes away at 95, or if he passed away before that, obviously she would get that money before that. Now, with regards to income, I do want to focus on that they need $60,000 after tax while Andrea is still working. And then they wanted to see what's the maximum amount I can get in retirement if we kind of, fully retire both of us at 62 and 70. And you can see the number, 71,973. And again, this is with John taking CPP at 65. What happens if we bump John's CPP till age 70 and went back into the report and said, look, let's actually defer CPP for John and let's run to see if we can get actually more income later on. So again, we want to do the sustainability spending at age 70 and 62 when they're both fully retired. And we can see here that it'll actually spit out more money. So 73,741, which is $1,700 more after tax in their pocket adjusted to inflation. So when we run this, you'll see now there's no CPP for John until 70. It's a bigger amount at 70 because he's deferred it. At age 70, when Andrea turns 70, you can see the number jumps to $52,000 now. That's adjusted to inflation. So when you look at their total CPP and old age secured at 70, we got $52,000 for CPP and another $25,000 for old age security. So that's about $78,000 before tax. But again, their tax rate's very low, but that's great index inflation and retirement income in their pocket. So in this case, even though there's a big age gap for them, that 8 years, it still made sense or put more money in their pocket for John to defer his CPP. Now, again, it's going to be different depending on other assets and cash flows you have. So again, work through these numbers with your financial planner, but even with the age gap, it still makes sense to defer it all away. The survivor benefit's based on age 65 CPP, so it does not affect the survivor benefit. It only affects how much cash flow they have in their retirement. So if John's healthy, plans to live on, life expectancy, it would still make sense for them to take it at age 70. Now, I want to go back to Andrea's CPP. Typically, when you have a younger spouse like that, the concern is, well, when John passes away, is Andrea going to be okay? And that's my concern. If I pass away early, is Steph and my kids, but especially when my kids get out of the house and it's just me and Steph, is Steph going to be okay? Is she going to have enough money? Is she well taken care of? And by having a larger Canadian pension plan and old age security, having that larger amount of money coming in guaranteed, adjusted to inflation, basically our defined benefit pension plan, that's what I want. So in this case, by having Andrea take it at age 70, it's going to be a larger amount. So if she continues to live on years longer than John in this case, there's a 8-year age gap, plus typically women live longer, she could live 10 or 15 years longer than John after he passes away. So by having that larger Canadian pension plan, it's like having a larger defined benefit pension plan. It's guaranteed income. So if you have a bit of an age gap, for that younger spouse, consider delaying that CPP all the way till 70 to get that large amount to bring cost certainty. And it also allows you to spend some of your money that you've built up in time in your go-go, slow-go phase of retirement as that age gap happens. So again, with John and Andrea, their go-go phase is spread out because of their age gap. So then they can spend more of their money and later on in life, rely on the government, index to inflation, not have to worry about investments. Speaking of investments, the other byproduct of doing a plan like this is when John passes away, if he was the one that took care of the finances, did the investing, he's leaving that on Andrea. And if Andrea's income is primarily the Canadian pension plan and old age security and a bit of survivor benefit, she doesn't have to worry about investing the money, worrying about managing that and figuring out how it all works. It's guaranteed income. She has her pension coming in. So it's much less stressful for her. It's guaranteed. It's a way better situation for her to be in the later years of life. So if you're someone that has an age gap or maybe a gap in retirement years, and there's this kind of middle ground of what do we do when one person's working, one person's not? Again, the person that's not working, start drawing an income. How much, when, where from? Figure that out with your financial planner. If you need help with that, reach out to our office. We'd love to help you out and build out a proper retirement plan. Look at different scenarios with you. parallelwealth.com/planning. So that age gap. Look at CPP timing. Look at drawdown of accounts. You need to look at longevity. Just because there's an age gap doesn't mean the older person should take their CPP right away. Typically, it makes sense to defer it. So all these things that when I talk to people with age gaps, they think, well, I need to do this. When we run the numbers, it's typically the opposite of that. So again, this is why it's really important to take your information, put it into software, look at different scenarios with your financial planner to figure out where that sweet spot is for you. Everybody's retirement's a little bit different. Don't rely on your neighbor or coworker for advice. They typically don't know what they're doing. Talk to a professional, get professional advice, and make sure you're putting the most money back in your pocket versus CRA. Because if all Canadians can agree on one thing, is we want to pay CRA less money and put the money back in our pocket. And there's ways to do that with retirement planning if done properly. So make sure you take that step and get it done.